Right. Hey, everybody. Eric Weiss here. It's been a minute. I haven't recorded any new content in a while. I got really busy. I had a bunch of really great clients come on board, and I've been heads down and working with some great teams on some great challenges. Now I've come up for air a little bit, and I've created a bunch of content for my clients over the past several months that I wanted to kind of get out there in the world. And so I'll be sharing more. I also have a new podcast that I'll be launching in the next few weeks. So stay tuned for that. But it's going to be pretty amazing. I got a world-class team on board, and this is going to be legit. So stay tuned for that. So the talk or the content that I'm going to be sharing today is one that I created for an executive forum that I did last week, and it is very timely with what's going on in the economy these days, especially in the tech industry. And so I wanted to get this out there to help some of you folks. And I call it War and Peace: How to Change Your Leadership Style to Meet a New Economic Environment. Um, Things have been a little wild lately. Obviously, there is talks of a recession. Maybe it's not talks. A recession is happening, and it's really throwing the tech industry into turmoil. And so I've been working with all of my clients on how to understand what's going on, how to assess their business, and how to plan for the economic paradigm shift, right? Moving into this new phase in the economy. So this was an executive forum. About half of it is focused on kind of the broader economic landscape, and then half of it is focused on leadership and how we need to transition from a peacetime to a wartime leader. This was, again, a workshop based, so there's a lot of discussion questions in here. And so I'll pose those to you as journaling prompts. So when a question comes up, I want you to take that away, screen cap it, write it down, and collect your thoughts around how you can address this in your own company. Even take it to your team, right? These are very important discussion questions to be had with your team to figure out, again, how you can make your business more efficient to last through this next economic cycle, make yourself more attractive to investors that are still out there investing, and then ultimately how you can change yourself as a leader to meet the challenge of the day. All right. So I'll pause on those discussion questions, kind of give you a moment to capture it, but that will be homework. All right. So let me go ahead and switch over to my slide deck here. All right. Let's get into it. So for those of you who don't know me, my name is Eric Weiss. I'm an executive coach. I work primarily with tech companies in the growth and scale stages and help them with the growing pains. So as companies grow and mature, their teams, their business processes, their products, everything needs to scale up. So I help them not only build those systems to scale, but then also help them deal with the inevitable stress that comes along with that. And so I help leaders develop themselves, mature, and ultimately avoid burnout and find more balance in life. Got a long background in the tech industry, my whole career, been an engineer, a CTO, a product manager, a founder, an investor, an advisor, a mentor, pretty much done everything. But as an executive coach, I focus on one-on-one and group coaching with CEOs, founders, heads of product and engineering in growing tech businesses. Okay. All right. So let's get to it. Where have we been up until now? For the last months and years, it's been wild. I won't say it's all been a party. Obviously, let's put COVID aside for a moment. It certainly hasn't been fun, but from a business perspective, it has been crazy. Money has been printed in an unprecedented fashion. And so VCs especially have been handing out money like crazy, ridiculously large rounds at ridiculous valuations. And that's created a culture in the tech industry that that has allowed them to become incredibly inefficient, right? Spend as much as you possibly can because there's always going to be more money on the other side. So a lot of companies right now that have incredibly high burn rates, that haven't yet found product market fit, that are very inefficient in their business model are really sweating right now. Some of them have even gone ahead and closed already. But for everybody else, this is a wake-up call. Okay. But so suffice it to say, there's been rapid growth, both from products, but also from, from team sizes. We've had to shift to remote work and adapt our leadership styles. We have been dealing with an unprecedented labor market where wage inflation has been insane, and companies have had to bend over backwards to hire and retain not only great talent, but pretty much any talent. And so the focus has really been on making people happy, right? So adjusting our expectations and adjusting our leadership and our management to simply keep people, keep them not only motivated and engaged, but to keep them from going next door to that next best opportunity. Okay. So kind of first journaling question is for you simply to take stock and reflect on what challenges have you been focusing on the most over the last year. And that will be laying some context or some groundwork for now that things are changing. Are the challenges that you've been focusing on still the most important things, right? Especially with growth expectations shifting, we might need to baseline our goals and the things that we've been focusing on in terms of growing our business, growing our teams, and exploring new opportunities as opposed to making the products that we have better. So where are we now? Well, party's over. Things have definitely taken a turn for the worse, but this is all predictable. This is a compounding of various factors that were all expected. It's very unfortunate that they're all kind of happening all at once. But this is a different black swan event to what we've seen, certainly with the pandemic, but even back to the 2008 crisis. This is simply, kind of the chickens coming home to roost. The policies that our government and our economies have made over the last several years are now finally reached that point where there's a reckoning. Nobody knows how bad it's going to be or how long it's going to last. But what we do know is right now we're in a pause. There's still tons of money out there, right? The Fed has printed trillions and trillions of dollars. So the VCs have capital to be deployed, right? And companies have raised money and need to spend that money to fuel their own growth so that they can continue to raise in the future. But right now, everybody has pulled the emergency brake and are trying to reassess what's going on right now, trying to understand not only what the immediate factors are in terms of rising interest rates and so on, but what are the second and third order consequences of that, right? How do rising interest rates affect our particular business and our particular industry and our customers and what have you? So everybody's kind of overreacting right now. But suffice it to say, there's still money out there to be deployed. It's not like everything has just dried up overnight. It's just they pulled the emergency brake and are reassessing and re-strategizing. So unfortunately, a lot of companies, and my clients included, are making a lot of preemptive deep cuts to their business. And my advice to them is don't panic, okay? Yes, this moment is all about looking inward, reflecting, zeroing in on your metrics and on your business engine, cutting fat and creating efficiency, but not to amputate limbs, right? Not to cut so much flesh that you lose momentum and are unable to sustain any form of growth over the next, say, 1 to 2 years. So that's what I'm really focusing on with my clients right now is absolutely tighten your belt and absolutely look for waste and inefficiency, but be careful about creating an anemic workforce so that you can't continue on and sustain a healthy level of growth. Again, just like the VCs are doing, pause, reassess, assess internally as well as your market, update your strategy and adapt to the new times, and ultimately get to what's called default alive or default investable. And if you haven't heard about it right now, Just Google it. So this concept has been pushed out by Y Combinator, has become very popular in sort of the startup ecosystem very recently. But basically, the idea is don't run out of money. Default alive is essentially the equation that says, given the cash that we have on hand, given our monthly expenses, and given our current pace of growth, will we be able to get to break even or cash flow positive before we run out of money? And so that's the scenario that you simply don't need to raise another round. And some people say, well, that's nice, but for early stage companies, it's just completely unfeasible. And other companies say, well, we have to be aggressive in terms of our growth. So we still have to plan to some degree on being able to raise money. There's still money out there to raise. And so other folks, one notable David Sachs of Craft Ventures has published a video that's become very popular, basically challenging that default alive scenario and focusing on default investable, which basically means, yes, you are driving towards default alive, but it's really focused on having incredibly strong financial and product metrics so that you become very attractive to VCs. Because again, it's not that VCs aren't deploying capital anymore. They're just de-risking. And so they're focusing on stronger companies and companies with more predictability and certainty in their business model than the earlier stage or the more speculative ones. So if you're early stage, this is all about extending your runway until you can get to default investable. If you are already in market and already growing, again, it's about extending your runway and making yourself attractive for that next round. And if you're a little bit later stage, yes, absolutely go for default investable. Default alive. Okay. So David Sachs, again, in this video, which I strongly recommend you watch, it is a great summary of what's going on right now in the economy, in the tech economy, I guess I should say, because it's focused on the VC market, how to operate in a changing startup environment. He laid out 4 winnable scenarios here, right? 1 is you're already cash flow positive. 2 is your default alive, which means you are driving towards cash flow positive and don't need to raise another round unless you want to, right? In order to fuel your growth. Default investable means we're not alive, but we've got great, strong metrics and be very attractive to investors. Or we're that lean startup, which means we can extend our runway as long as possible, possibly even up to 2 to 3 years, and iterate on our product until we get to product market fit, improving those metrics to get to default investable. Everything else is no man's land, right? And so he actually goes on and lays out a table of metrics. So what I'm doing with my clients right now is actually running them through these models of, again, the cash on hand, your growth rate, your burn rate, your retention rate, et cetera, to see how investable and how attractive you would be to VCs. Okay. So a question for you then is to reflect on how is your own market landscape shifted? I've talked with many different founders in many different industries who are living through different scenarios right now, right? If you are certainly if you're in the real estate business, your scenario is different from somebody who may be in, B2B versus B2C. And so really think about not just interest rates have gone up and money has dried up from a fundraising perspective, but really what is your business model? What assumptions and what trends is your business model based on that may have changed, right? That might impact your financial projections and then your ability to raise money. Because all of these growth models, all the models that I presented earlier, are all based on growth, which is, it's almost assumed a constant level of growth, which is wrong, or certainly something that you can't control for. So they all take in a constant level of growth as an input, and then all these other things that you can control. But the real focus on is can you continue to expect or continue to rely on your growth rate, your month over month or year over year growth rate that you've had previously. And so whatever model you've created up until now, you need to reassess your growth projections. And therefore, not only your growth in terms of revenue, but also your growth in terms of team size and of expenses. Okay. So then looking at those market shifts, what changes would you have to make to get to default alive or default investable? A lot of what we're going to be talking about here is really around cost. Cost in, your fixed and variable, right? So what's your cost of doing business, but then also what's your cost of delivering your service, and figuring out ways to achieve more efficiency. So one of the things that I'm recommending for all my clients right now is cut out some of the greenfield work, right? Take the risk out of your business by focusing less on new features and more on how do we improve our existing features and our existing product line, right? So improving our user experience, improving our quality, right? Doing more to make what you already have better, as opposed to going out and going after greenfield opportunities that aren't vetted and aren't validated. Okay. And then specifically getting down to what key metric is out of whack, right? What key metric can you focus on that would unlock the most growth? All right. So where are we headed from here? Well, again, we don't know. But we know that we are moving into a realm of more uncertainty. And so with more uncertainty means less and less desire to take risk, both in terms of fundraising, but also in terms of leadership as well. We need to focus on de-risking our business. So investing in and doubling down on what we already know, right? So we're seeing this in the VC market already, is that they are more inclined to invest more into their portfolio companies that are already doing well than they are going after new opportunities and new additions to their portfolio. So the same thing, again, internally, focus on the products and features and customers that you already have, and whether it's improving the product experience, improving your retention, improving your ability to monetize existing customers, or increase your market share, right, in your existing markets. It is not the time to go speculate, to scout, to go into greenfield. All right. What this also means is more flat and down rounds. So I know that's unfortunate, but hey, we're coming out of an irrational market here where valuations were pretty crazy, and they're simply just going to have to come back down to earth. And so the unfortunate thing here, flat and down round, of course it sucks for founders to be diluted and to lower your expectations of an acquisition. But where it really practically becomes a problem is when your existing investors start to get in the way of your ability to raise new money. And so if you do have to raise money in the next, say, 12 to 18 months, you need to have that conversation with your existing investors to say, hey, it's not that we're doing poorly. It's that the entire market has shifted and we just have to become more accepting of, again, a lower round. Now, hopefully you haven't taken money that has those terms such that you're going to lose it as a founder, but that might be the case. You might have to cut off some of your payday in order to achieve that next round and continue to move forward. But again, what does that mean? It means if you can extend your runway, you can ride through this downturn, you might get to a place where you can at least get to flat, maybe even a little bit of growth here. But if you do have to raise money again in the next, say, couple of years, be ready for a haircut. All right. And again, the focus is on unit economics. More than anything, this is the name of the game. And in fact, I would say this is the key takeaway. There's one thing you take away from this whole conversation: focusing on unit economics, which means, can you provide an efficient service that is valuable to your customers and deliver it to them for less than it costs for you to acquire that customer and deliver that service, right? And so there are, again, Google it, unit economic models where you can track what are all of the costs that go into acquiring and retaining customers and delivering a service, and how can we make that more efficient, right? Obviously, retention is the name of the game. It's always the name of the game, even in good times. How can we increase retention? How can we increase our margins, right? How can we decrease our cost of acquisition such that our unit economics are stronger? And a lot of what this comes down to is, capital efficiency, being more efficient with our hiring, also being more efficient with our execution. So focusing our priorities, fewer number of initiatives, fewer number of goals, fewer number of even teams, fewer number of features that we're going after simultaneously, so we can hone in on a few key things that are going to improve our unit economics and enable us to continue that growth path. And if you're able to do this, VCs are eager to invest. In fact, I have a couple clients right now that have actually had unsolicited investment inquiry from VCs or private equity firms because they had such strong unit economics that the VCs are looking for places to put their money to de-risk the rest of their portfolio. Okay. So if you can show that at any scale, you're able to make more money than you put into it, then the conversation around the fundraise becomes different. It's rather than saying, hey, help us bridge the gap to profitability. It's let's scale this thing that already works. Let's scale this thing that we know is profitable at whatever scale we're at now, and growing cautiously and intentionally so that we can maintain that profitability at larger scales. VCs are all over that right now. All right. So question for you, what can you focus on in the next quarter that would have the most impact on your unit economics? We talked about CAC. We talked about retention, right? We talk about capital efficiency. What are the things that you can do to increase the value, decrease the cost, decrease the time to market, right? Decrease the sales cycle so that you can provide a valuable and efficient service. Okay. Then if you tried to raise money right now, what would VCs balk at? What would they say your biggest risks are? In fact, if you are raising money right now, they're probably telling you no for some reason. What are they saying? That should be the core focus of your business. How can we mitigate the risk? And how can we make ourselves more attractive to investors, assuming you can't extend your runway to the point where you can get to default alive or cash flow positive? If you're going to have to raise money in the next 2 to 3 years, is what we're looking at right now. The focus from here on out is de-risking your business. Okay. Putting the economy aside, let's talk about how we meet the future as leaders. What have we been doing up until now? We've been in peacetime. So what is peacetime leadership? Peacetime is when we're investing in ourselves, we're investing in our teams, we're investing in our customers, in relationships, and in personal growth, right? It's when we train. It's when we build camaraderie and loyalty, right? It's when we clarify our vision and mission. It's when we're taking the most risk. We're exploring uncharted territory because the stakes are lower, right? And building scalable and durable systems, right? When it's during peacetime, we're building something that can withstand wartime, right? Or something that can withstand the long term. And we're building teams that are tight and bonded so that if and when things do get difficult, we stick together. Okay. So this is my summary of peacetime leadership and where I've been focusing with my clients up until now, right? So we look at how do we become better leaders? We look at how we can create more cohesive and more effective teams. How do we build loyalty, especially in a remote work environment where things have become a lot more transactional and opportunistic? How do we build camaraderie and loyalty in this remote world? How do we clarify and communicate our vision and mission to inspire people and to make our company more attractive to employees, investors, and customers, right? Let's go after some big risks. Let's not play it safe, right? There's money on the table. Let's go after some big, hairy, audacious goals. And then let's build systems that can scale because we're going to be pouring more money on this thing. Growth is happening. And so we have to build a company that can scale. That's where we've been. Okay. The key thing here is around building that loyalty and camaraderie, because as we move into wartime, things are going to get dark potentially, and people are going to start to scatter, and we don't want that. And so the investments that we've made in our team up until now is the thing that's going to take us through the storm to the other side. So my question to you is, how have you invested in your people so that they would stick with you during tough times? Okay. And it's not too late. It's not too late to invest in your team, to lean in and connect with people. But you have to ask yourself honestly, have you been supporting and investing in and growing your team? Or have you been taking advantage of and exploiting your team? And the reckoning is going to come for the entrepreneurs and the leaders who have been grinding away, who have been pushing their teams to work as much as possible, who haven't really been paying attention to their needs. It's going to be a difficult time for you. So now is the time, if you haven't already, now is the time to really connect with your people, to talk to them about how are they feeling? What are they afraid of? What are their goals? What are their needs, right? Make them feel more confident. Make them feel more connected to you and to your mission. Bring the teams together and invest in team building and bonding exercises. And then clarify your story of your vision and mission so that they believe in the cause and are willing to stick with it through tough times when things might be looking pretty bleak. So the idea here is we're heading into a storm. Okay, it's time to batten down the hatches and head into the unknown and know that we're heading in the right direction and we'll come out the other side. Maybe a little bit beat and bruised, but we'll survive and we'll be better on the other end, right? So where are we today? Wartime leadership. The first kind of myth that I want to dispel about wartime leadership is this isn't about going out and killing people. This isn't about being incredibly ruthless and whatnot. It's about getting serious about your business model, serious about your efficiencies, serious about the decisions that you're making, right? Whereas we might have been more relaxed about things. Now is the time to get laser focused, to cut away distractions, cut away side projects, cut away things that haven't been serving us, either from products, from customers, teams, people, leadership, ourselves. Now is the time to get real, right? And to understand what absolutely needs to happen in order for us to survive and make whatever tough decisions are necessary in order to meet that challenge. So again, in every aspect of our business, becoming more efficient, becoming lean, again, without amputating, without killing ourselves, but becoming as lean as possible, having focus, not only on the vision of the future, but also doing fewer things and focusing and honing in on execution, right? Taking decisive action, not vacillating, not waiting and seeing, but you have to make a decision now, right? Investing in sustainable growth. So not having insane burn rates and insane burn multiples, but having a cost burn rate that grows in proportion to your revenue growth, such that your revenue growth projections are tied to your cost growth projections and that you can turn the dial as needed, right? So if your growth projections stall out, you can easily dial back your costs in a way that maintains, that's proportional to that, right? And getting laser focused on key metrics. So if you haven't already, you should know every single number that drives your business, right? Every single input and output that drives your business, and to be able to understand exactly what is in the green, what's in the red, and be able to zoom in and inspect and understand why is this metric out of whack, right? Or how do we improve, these key business drivers. All right. So to me, that's wartime leadership. And that's what I'm focusing on with all my clients right now is what are the distractions we can no longer live with? What are the inefficiencies that we can no longer tolerate? What are all the different priorities that we've been trying to do in parallel that we have to either serialize or cut away so that we can focus on execution on a few key areas at a time? And how do we become more data-driven, right? So that we're making real objective decisions. Okay. So This is a pretty key journaling question here for you. How do you need to transition from a peacetime to a wartime leader? What have you been either focusing on that is no longer critical to your survival? And what have you been ignoring that you need to now focus on, especially when it comes to your people and your leadership? Okay. What distractions can you no longer tolerate? Right? What problems are really not that important that you've been trying to fix? What opportunities are too speculative or too out there that haven't been validated that you're simply going to have to put aside, right? What can you no longer afford to pay attention to because you have to focus on a few key things that's going to get you through this storm, right? What tough decisions have you been avoiding? A lot of my work with my clients, I say, I either tell you what you don't want to hear, or I tell you what's staring you in the face that you haven't been seeing. Okay. There's something that is in the back of your mind, or maybe even in the front of your mind, that you've been avoiding, but you haven't been able to say it out loud, right? Or you haven't been able to really take it and own it, and make it actionable. So I want you to think about this. What tough decisions have you been made? And it could be somebody that needs to be let go, or a product or feature that needs to be cut that isn't working. It could be a new market segment that you've been going after that you just haven't been able to break into, right? Some tough decision that, as painful as it may be, you have to reconcile with in order to move forward. What has been holding you back? What has been creating friction? What's been wasteful that you can no longer afford to deal with? Okay. And then again, on the concept of focus, what if you had to choose one thing, one market, one customer, one product, one feature, one strategy, right, to focus on for the next year, 2 or 3, where you could go all in, and that could give you the best chance of success at riding out this storm? What would that be? And I would challenge you to really go all in, right? One market segment, one product line, one strategy, right? One customer persona or customer base for the next couple of years, and focus all your energies on that, because anytime you split your attention, you're now decreasing your velocity, your momentum in each of those directions. And in order to make it through, in order to make it 2 to 3 years down the road, we have to be incredibly efficient. We can't afford to split our attention anymore. Okay. And then lastly, what can you commit to changing today? And again, this is kind of roundtable in the workshop. I have everybody in the room actually commit to something to one another, that they're going to go and make a change, right? And so I would ask you to take this back to your team, going through, sharing this video, going through these journaling questions together, running this like a workshop, and then saying it out loud. What is the commitment that you're going to make? What tough decisions do you have to make? What do you have to let go of? What do you have to focus on in order to make it through the next couple of years, so that you can ensure your survival, so that you can increase the value to your customers, and so that you can make yourself more attractive to investors, so that you can continue to raise money, can continue to grow, and again, get to the other side of this thing. This isn't forever, right? The economy goes through cycles, but this is the big shaking of the tree, right? A lot of competitors are going to get burned out right now, right? The next couple of years, it's going to be a wasteland for startups, and especially tech companies across the board who are not efficient, who have not engaged with their customers and provide them a valuable service, who are not focused, who are not data-driven, and who are not focusing on their unit economics and sustainable growth. All of those companies that are wildly speculative, that are burning money like crazy, that are not taking care of their teams, that are not connected with their customers, they're going to die. And hopefully you can be the one left standing because you followed this advice. Okay, that's it. I hope that was super valuable. If you have any questions, or if you'd like me to help you actually implement this in your own company, reach out to me. You can email me, eric@fullcycleproduct.com. You can find me on LinkedIn. You can even go ahead and book a consultation with me. I help, again, one-on-one or in group coaching. I help many clients, different industries, different sizes, different stages of growth, help them through those growing pains and help them get serious about their business. All right. I hope that was valuable for you, and have a wonderful day. Take care.